Good evening, everyone. Welcome back to live classes of ICI. I hope you guys are doing good. All good, guys. Let me see who all are there. Vedika is there, Jyoti is there, Vaishali, Lakshmi, Priyanka, Parth Sarthi. Okay. Good evening. Good evening, everyone. Uh, let's first have the plan for the day. So we plan to move in a typical pattern in which I'll be solving the two practice questions which I've uploaded on the portal, on ICI portal, on the BOS portal. And while I'm solving that, I would request you guys to just put up the questions from study material which you want me to solve. And just let me know the questions which you want me to solve from the study material. I'll check the chat box for that case. And once I complete those two questions, I'll look into the questions which you are having doubts from the study material. And then after that, we are left with some small concept of DuPont analysis and two ratios, which we'll be doing in the last part of our today's session. Okay, so let me just simply get started with the question that I have uploaded on the portal, which is the first question. Yeah. Okay, guys. So I get to know that illustration 2 needs to be solved. Okay, I'll take that into consideration. I'll surely take that into consideration. Illustration 2. Alok, is it illustration 2 or are we talking of the practice problem 2? Yeah. DuPont analysis, I'll do, Janesh. Janesh, I'll be doing the DuPont analysis towards the end of our today's session. Okay, so I've got one request from Alok, which is illustration 2. Any other question from study material you want, you can surely let me know about it in the session. Okay, I hope you guys are able to see the screen with the question. I have uploaded this question on the portal. I hope you are able to access it. True? Is it right, guys? I hope you're able to access this document from the portal, right, guys? Correct? Okay, illustration 4 and 5 are the further requests. Okay. I'll be uploading this entire notes file after today's session, guys, so that you will be able to access the solution to the questions as well as the written notes. Okay, fine. So let's get started without much wasting time. Let's simply get started with the first question from the document, and then we can go for the second later on. Okay, so the question says, the following accounting and financial information of PQR Limited relate to year ended 31st December. Gross profit equal to 15% of sales. Net profit is 8% of sales. Raw material consumed is 20% of the works cost. Direct wages is 10% of works cost. Stock of raw material is 3 months usage. Stock of finished goods is 6% of works cost. Debtors collection period is 60 days. Fixed asset to sales ratio is 1:3. Fixed asset to current ratio is given as 13:11. Current ratio is 2:1. Long-term loan to current liabilities is 2:1. And capital to reserves and surplus is 1:4. We have been given the value of fixed assets as on 31st December amounts to 26 lakh, and we have to prepare the summarized profit and loss account. Okay. So how do we get started with this question, guys? From which area should I start? Yeah, from where should we start? One second. So gross profit is given, capital to reserves ratio is given, and then the only area which we can actually start is from, you know, hmm. So we can begin from this point, that is value of fixed asset as on 31st December is given as 26 lakhs. So we have to start our solution from this point, which is about the fixed assets of 26 lakh. Now, in relation to fixed assets, we need to look at the ratio that we have connected with this 26 lakh. We have the ratio of connected to fixed assets as this one, fixed asset to sales ratio. So we need to essentially start our solution with this point, fixed asset to sales, and then take it forward with the other numbers. Okay. So right now, let's just try to solve this. We will try to solve it in Excel so that we'll be able to quickly go ahead with the calculation portion. Let me just open up the Excel file. Yeah. Okay. So here we have the question on the other side. So the first ratio that we are going to use, I don't know. Problem is going on. Why it's not working? Anyways, let me open the new file altogether. Okay, fine. Let's continue, guys. I think that sheet should be visible now. Yeah, the first thing that we need to do is, uh, yeah, okay. हाँ ड्रैग यहाँ पे okay. Is it okay now? अच्छा ठीक हाँ अभी ठीक है yeah. Okay, so let's proceed, guys. We have as the ratios given over here. First ratio that we have is to be used is the fixed asset to sales ratio. So we have been given that it is fixed assets to sales, right? So this ratio is given as fixed asset to sales is given as 1:3. We're given 1:3. So basically that's going to be 1 divided by 3. So it's 1:3 or 1 divided by 3. That's the ratio given, fixed asset to sale. Uh, and in the question, they have given us that it's that fixed asset is equal to 26 lakhs. Fixed asset is equal to 26 lakh. And from this, we can actually get the sales figure because that would be based on this number itself. Fixed asset, if it's 26 lakh, and if you want the sales, so fixed asset to sales, if you talk of what will be the sales figure, right? So if your fixed asset is 26 lakh, fixed asset to sales figure is 1:3. So we can get the sale from here by using this ratio simply as 26 lakh upon sales is equal to 1 by 3. Correct? So from this, we can get the sales figure as simply 26 lakh multiplied with 3, which is 78 lakh. So sales figure stands as 78 lakhs. Okay. Okay. So we get the initial sales figure as 78 lakh. That's the first part of our solution. Then looking at the other ratios, if you look into the question, uh, connected with sales, we can compute a lot of other items. And connected with the fixed asset itself, we have in the question fixed asset to current assets. Fixed asset to current asset ratio is also there. So one thing that we got is sales figure. The other ratio that we will use is fixed assets to current assets. Now this ratio, fixed assets to current assets, is given as fixed asset to current asset is given in the question as 13 is to 11. So that's 13 is to 11. Now, so accordingly, if we write down the fixed assets figure as 26 lakh, 26 lakh upon current asset is equal to 13 by 11. So simply speaking, the current asset figure is going to be this 26 lakh multiplied with 26 lakh multiplied with 11 and then divide it by 13. We get the current assets figure as 26 lakh into 11 divided by 13, which is 22 lakh. The second number that we got, second information that we got is 22 lakh current assets. Okay, so that's the second item which we got from the ratio. Sales is arrived at 78 lakh, current asset is 22 lakh. Now, obviously, as we have got current assets, we can simply get the current liabilities also. Since we have in the question current ratio as 2 is to 1. So the current ratio given in the question, if you observe point J, that's 2 is to 1. So we can say current ratio, which is simply current asset upon current liability. That's equal to current assets of 22 lakh upon current liability. And that is equal to current ratio is given as 2 is to 1. So from this, we can simply say current liability equal to that's going to be the arrangement. Current liability will be 22 lakhs divided by 2. That will be 22 lakh divided by 2. That's 11 lakh. Okay. So current assets 22 lakh, current liability 11 lakh. So as of now, we have got three figures: sales, current asset, current liability. Sales, current assets, and current liabilities. Then, connected with the current liabilities, we have a ratio in the question itself, which is long-term loans to current liability. So let's use that. Long-term loan to current liability, and that ratio is given as long-term loan to current liability is again 2 is to 1. So in that scenario, long-term loan to current liability. So the long-term loan upon a current liability of 11 lakh. Current liability of 11 lakh is equal to 2 by 1. We have long-term loan as simply, it's going to be 11 lakh divided by 2, which is 55 lakh. Long-term loan divided by 2, which will be 5 lakh 50,000. My bad. So we have got long-term loan 5 lakh 50,000, current asset, current liability, and sales figure is ready with us. Okay. Then the next thing that we have, once you have got the long-term loan, now since we have computed the sales, connected with sales, whatever ratios we have, we need to complete it together, complete it all together. Okay. So let's begin with the ratio. First up, connected with the sales, we have debtors collection period, and then we have the other items as first connected with sales we have gross profit, right? So let's complete that portion connected with sales. Let me just put it over here on this side. We have got over here. Yeah. With sales, we have gross profit figure as 15% of sales. And remember, we want to prepare the summarized P&L and balance sheet. So we need complete details. So first talking of gross profit. So gross profit is 15% of sales. That's equal to 15% of 78 lakh, right? We can simply say the gross profit is equal to 78 lakh multiplied by 15%. That's 11 lakh 70,000. We get the gross profit figure as 11 lakh 50,000. Gross profit is 11 lakh 50,000. Net profit is stated to be 8%. So we can compute the net profit also easily. Net profit is 8% of sales. Is 8% of sales. That 8% multiplied with the sales which you have got, right? So we got this net profit, right? We got the gross profit, we got the net profit. Then we have raw material consumed, given in the question is 20% of works cost. Raw material consumed is 20% of works cost. So now, of course, the works cost will comprise of raw material, wages, and some other production costs also. So we need to wait to check for it as to how do we get that works cost. It is 20% of works cost. We'll get to know about the works cost. But ideally, if you talk of works cost, it's going to be based on our gross profit. That's going to be based on our gross profit. So works cost is simply going to be, or works cost as a percentage of sale, as a percentage of sale. Works cost as a percentage of sale. That's going to be, since gross profit percentage is 50%, ideally we can say that works cost will be the balance 85%, right? 100% minus the GP percent. That's equal to exactly 100% minus 15%. And that's equal to 85%. as the works cost. The works cost we get as a percentage of sales, it is 85%. So if you talk of the amount, works cost is 85% of sales figure, right? So 85% of sales, 85% of sales, that 66 lakh 30,000 is the works cost that we get. Okay, 66 lakh 30,000 is the works cost that figure we get. Now, based on this works cost figure itself, we have to calculate a lot of other things. So we have raw material consumed. Raw material consumed is going to be 20% of works cost. So there is 20% of works cost, and that translates to 20% of 66 lakh 30,000. 20% of works cost, 66 lakh 30,000. So raw material consumed is 13 lakh 26,000. Correct. Yeah, raw material consumed is 13 lakh 26,000. Then after this, raw material consumed is given. Direct wages is 10% of work cost. So direct wages is stated to be 20% of, sorry, 10% of work cost. 10% of works cost. This means our direct wages are essentially going to be 10% of this works cost figure, which is 66 lakh 30,000 being the work cost. So direct wages, we get this figure. Okay, the raw material consumed is 13 lakh 26,000. Direct wages is 66 lakh. Direct wages is 66 lakh, sorry, 6 lakh 63,000. Then uh, direct wages adjustment is done. Stock of raw material. Now, with regards to stock of raw material, they're saying it's 3 months usage. The stock of raw material, we have to take it as 3 months usage. So, yeah, stock of raw material is 3 months usage. 3 months usage. So, what is this 3 months usage? It's essentially whatever is the raw material consumed, whatever is the raw material consumed, that's for the full year. So, raw material required for 3 months is what is kept in the stock. Raw material that's required for 3 months is what is kept in the stock. So we can get the stock of raw material easily as simply this raw material consumed, that's for the full year. So for 3 months, that's going to be 3 divided by 12. So out of full year, 3 months of the raw material is kept as stock. So we can say stock of raw material is 3,31,500. Okay. Stock of raw material is 3,31,500. Done. Then the next ratio that we have, yeah, stock of raw material is 3 months. Stock of finished goods is 6% of works cost. We have stock of finished goods. Stock of finished goods is 6% of works cost. 6% of works cost. So that essentially means that it is going to be 6% of the works cost, which is this figure. 66 lakh 30,000 is the works cost. So we get the stock of finished goods as 3 lakh 97 800. Okay. 3 lakh 97 800 is the stock of finished goods. Next ratio that we have is debtors collection period being 60 days. So debtors collection period being 60 days. Now debtors collection period being 60 days. How do we get this debtors collection period? We know it is the average debtors upon the debtors turnover. But simply if we can say, in the logic of stock of raw material, debtors collection period is 60 days means a total of 60 days sales remains in the form of debtors, correct? So we can simply say that so debtors will be 60 by 360. So 360 is what we are assuming over here. To make the calculation easier, you can take 365 also. You will get a bit different answer, but that's fine. So debtors is 60 by 360 times of 60 by 360 times of the sales that we have. So that sales is 78 lakh anyway, right? So we had a sales as 78 lakh. So the debtors balance is going to be equal to 78 lakh. That was the sales which we had calculated. 78 lakh into 60 divided by 360. So debtors amount is 13 lakh. Amount of debtors is 13 lakh. Okay. Then we have fixed asset to sales ratio. Of course, that is used, right? We have obtained the sales from that. Fixed asset to current asset ratio, we have calculated the current asset from it. Current ratio also what we have used. Long-term loans to current liability, we have computed even the long-term loans. Now, capital reserve to surplus is what is pending, but that will be using it at a later stage. Let's first try to get the structure of at least the balance sheet and P&L. So let me just prepare the structure. Uh, Maybe somewhere over here. Yeah. So we'll have it over here as profit and loss account. Or to be precise, trading and profit and loss account. Trading and profit and loss account. And similarly, we'll have one more format over here that will be for the balance sheet. Trading and profit and loss account and the balance sheet. Hmm. Let me just have a proper format that will looks really good. Really over here for the balance sheet. Okay. So in trading and profit and loss account, first we know we write down the sales. The sales figure is what we have got as 78 lakhs. Sales is what we have computed as 78 lakhs. Then the other side, raw material consumed. Raw material consumed. Just write it in short form. Raw material consumed is what we have computed as 13 lakh 26,000 earlier, right? Raw material consumed. Then after this, we have in the trading account direct wages. So direct wages also we have computed as 6 lakh 63,000. And remember, we had the gross profit figure. So gross profit was computed as 11 lakh 70,000. Now, of course, I need to tally this trading account. And you may say, sir, it's not tallying because, as I said, this is just few portion of your work cost. Our other works, our works cost may be remaining with other production costs. You can simply say other production cost. The other production cost is simply going to be the balancing figure. This is our balancing figure. This remember, this is our balancing figure. Right. So balancing figure, we just try to get it done. We like that minus this minus the direct wages minus the profit. The balancing figure is 46 lakh 41,000. Okay, so here we get this trading account. Then this gross profit, as we know from the format itself, it's brought forward. Gross profit will be brought forward as it is 11 lakh 70. And then let's look at the expenses, the other expenses that we can put in the trading and P&L account. I don't think there's any details of other expenses, but one thing that we have is the net profit figure. Now, the net profit figure is what we have computed to be this one, 6 lakh 24,000, right? So let's just link it over here, 6 lakh 24,000. Net profit, 6 lakh 24,000. And then we have, of course, the other expenses because there's nothing left now. Yeah. So other expenses will be, yes, obviously, the balancing figure over here, right? So this is again a sort of balancing figure for us, which is a net other expenses as 5 lakh 46,000. So that's our trading account and the trading and the P&L account. Now the big thing remains is the balance sheet. So in the balance sheet, we have the fixed asset, or we call that as other current assets, right? Sorry, not my bad. Those are called as non-current assets, not other current. Non-current assets, or what we call it as fixed assets. Non-current assets that's given in the question, 26 lakh, right? 26 lakh. Now, that was non-current assets, 26 lakh. Then we have the current assets details. We know that in totality, the current assets was totaling to something. What was the total of current assets, by the way? I think we have got it at the very start. Current assets, yeah, current assets was 22 lakh, current liability was 11 lakh. Let's just punch it over here. The current asset, we know it's totaling to 22 lakh. Now, within that current assets, we have information about raw material stock. We have finished goods stock, right? Then we have the debtors value. Let's just punch in and try to see if the total is coming out to 22 lakhs in current assets form. So raw material stock is what we have as 3 lakh 31,500. Finished good stock is what we get as 3 lakh 97,800. And debtors, as we have computed earlier, that it's 13 lakh. Debtors is 13 lakh. Okay. So if you take a total of this, it doesn't seem to be like 22 lakh. So there is still something balanced that we need to do. And of course, the balancing figure is just going to be the bank balance. Right. So bank balance, that's going to be this minus the current assets figure. 1,70,700 is the bank balance, is the balancing figure basically. Now coming to the liability side, we have share capital. Share capital. Then we have the reserves. There is long-term loan also, right? We have computed earlier long-term loan. And then we have the current liability. Okay. So current liabilities, we have computed the current liabilities as 11 lakh, correct? Even long-term loan we have computed as 5 lakh 50,000. Is it long-term loan 5 lakh 50? No, my bad, right? Long-term loan should be 11 lakh into 2, 22 lakh, correct? Long-term loan will be 22 lakh, correct? So if you take a total of our asset and the liabilities section, okay, so well, that's not definitely tallying because we haven't yet punched in the share capital and reserve. So undoubtedly, the share capital and reserves that should total up to 15 lakh, right? The share capital plus reserves is basically 48 lakh minus 33 lakh. Share capital plus reserve, 48 lakh minus 33 lakh, right? So again, the question says that there's a ratio between capital to reserve. Now, between share capital to reserves, the ratio is 1:4. So, sir, undoubtedly, share capital will be 15 lakh multiplied by 1/4, right? So, we get the share capital number 15 lakh into 1 divided by 4. 1 divided by 4, that will be 1/5. The share capital 3 lakh. We get a share capital of 3 lakh, and undoubtedly the reserves will become 12 lakh. That's how we complete the entire balance sheet. Right? So here we go. We have the balance sheet as well as the P&L ready in front of us. Now let me just check if there are some queries. Are there any queries? Stock of finished goods and raw material on credit side. There are some queries. One, open it on. Uh, hmm. Are we able to get this balance sheet? Yeah, guys. Let me just look at the query. Just a moment. Yeah. Let me see the questions now. Okay. So the query is, shouldn't we prepare the statement in the form as per Companies Act? Goma, need not be, because we are just preparing it for the sake of our analysis. So we need not write down all the items of Companies Act, or rather, we can even prepare it in T format, because we are not complying with any law as such. We are just preparing for our analysis purpose. Works cost will come in, Sharon. Works cost will definitely come in profit and loss, because your works cost is this three figure combined. That's raw material consumed, direct wages, and other production costs. If you combine them together, that's your works cost. Should we be taking the stock in trading account? Who's this? I think should taking. Why are we not taking? Yeah, Vidya. Stock account is not taken up in the trading account because we have considered raw material consumed. Okay, so this raw material consumed figure takes into account both raw material, that is stock purchased, as well as the opening stock and the closing stock. So the question is silent about opening stock. So whatever is our raw material stock, if you write it over here, you need to also calculate the raw material purchases and then write it. Okay. Should net profit be shown separately from reserves? Need not be. That's included in it. From where total assets have come. Honey, total assets have come from, I think it's Honey Agarwal. Yeah. That's a total of current assets and non-current assets. We should also write stock of finished goods or credit side. That's, I think I have answered it. Why are we not showing closing? That's what I have answered it. Brought forward or carried forward down, you can write it. Forgive me for the accounting terminology errors. There is a guy who is saying, sir, not written gross profit carried down. Okay. And gross profit brought forward. Okay. Satisfied now? Okay. Long-term loan will be, I have corrected that, Ganesh. Long-term loan is 22 lakhs. Explain Pal Vinodini is asking how debtors collection is related to sales. Debtors collection will be definitely related to sales because it's the debtors to whom you make the sales, right? So debtors outstanding figure will be dependent on how much sales you are making. So if you are giving them a 3 month credit period, 3 months of your sales figure will be outstanding as debtors, right? The debtors collection over here, we have the debtors equal to 60 by 360 into 78 lakh. 78 lakh was full year sale. So we were giving a 60 days credit to them. So therefore we have 60 by 360 as a figure. So out of 360 days sale, 60 days sales is outstanding as debtor. So that's what we have included over here. Okay, perfect. Fine. Good. Now I think we can go for the second question. Yeah, of course we can go for the second question. Let's go through the second question, guys. Let's go through the second question. This was question number one. Yeah, question two. Let's go to the question two. As you can see, question two is below is the balance sheet of Sunrise Limited as on 31st March 2011. Equity share capital 2 lakh, preference share capital 1 lakh, general reserve 40,000, 12% debenture 60,000, current liabilities 1 lakh. Fixed asset is given as 5 lakh less depreciation of 1 lakh 60. Stock in trade 60,000, sundry debtors 80,000, cash of 20,000. So we have some information available. We have to prepare a forecast of balance sheet as at 31st March 2012. Okay, so forecast, we have to prepare a forecast for next one full year. And they have given information of fixed assets costing 1 lakh will be installed on 1st April 2011 and would become operative on that date, for which payment will be made on 31st of March 2012. Okay. Fixed asset turnover is given as 1.5 on the basis of cost of fixed assets. Stock turnover ratio is 14.4 based on average stock figure again. Breakup of cost and profit would be as follows: materials 40%, labor 25%, manufacturing expenses 10%, selling and admin expenses, office and selling expenses 10%, depreciation 5%, profit is 10%, sales 100%, profit is subject to interest and taxation at 50%. Okay, the debtors would be 1/9 of the sale, while creditors will be 1/5 of material cost. Dividend will be also paid at the rate of 10%, and 50,000, 12% debentures will be issued on 1st April 2011. Okay, guys. So, we have to prepare a forecasted balance sheet. A forecasted balance sheet is what is required over here. But of course, for the forecasting of balance sheet, we need to prepare the P&L and other things also. So let's first try to have the balance sheet format ready for us. Okay. So whatever is there in the format, let's just try to put in balance sheet. We have liabilities, amount, we have asset, and the amount. So we are going to have an asset, fixed asset. Okay. Now even in the fixed asset, we are going to create two areas. One is the cost, and then less depreciation. You get basically the net block. Then we will have the stock. Then we'll have the debtors. From the question, we can find that there will be, of course, cash balance. Then on this side, we'll have equity share capital. Then we'll have 14% preference share. Then there's this general reserve, which I can find from the question itself. Of course, we'll be also having profit from the current year. So we would also have the profit and loss account. Then after profit and loss, we have the current liability. Current liabilities. But remember, we are apart from this current liability, we will be actually having uh, the debentures also which are issued by the company, right? So 12% debenture is also what we need over there. So this will be the structure or the format of the balance sheet. Let's just prepare this format first because so that it becomes easy for us to fill up the component, right? So talking about the one of the items one by one. Uh, First, it says that fixed asset costing 1 lakh will be installed on 1st April and it would become operative on that date for which payment will be made on 31st of March. Okay. So, obviously, the fixed assets that we have, of course, here, the fixed assets, cost is simply going to be the original value, the original value of fixed assets. The cost of fixed asset is given as 5 lakh. So, that's 5 lakh plus additional 1 lakh. So, this would become like 6 lakh. Right. So let me just put it into format. Yeah. The cost is 60 lakh. Now, of course, the depreciation that we are going to charge, it's already depreciated by 1 lakh 60,000. The original one was depreciated by 1 lakh 60,000. And this depreciation will be in addition to that. Right. So let's just do a working note maybe over here. Working note for depreciation. Working note for depreciation. So for depreciation, of course, the depreciation that it already has, uh, the brought forward depreciation of 1 lakh 60,000 plus a current year depreciation. So if you look at the depreciation rate, um, a simple analysis would help us to know what should be the depreciation rate. In the question, they have stated depreciation will be 5%. So I need to compute the depreciation. Now that is going to be computed as 5% of sales itself. So I actually need to prepare before this a profit and loss statement, because unless and until I have this profit and loss statement, I cannot have the entire calculation. So let's prepare the profit and loss statement. It obviously starts with sales. You're not preparing a formal profit and loss account as such. It's just a statement that we are preparing. From sales, we are going to reduce the material cost. Then we will reduce the labor cost, right? Then we have the manufacturing cost. We of course the production manufacturing cost. Then we have office and selling expenses. Office and selling expenses. Then you have the depreciation. Okay. Now these are the percentages given, which is like 100%. Material cost is given as 40% of sale. Labor cost is given in the question as 20% of sale. Manufacturing expense is 10% of sale. Office and selling expenses is 10% of sale. Depreciation will be 5% of sale. And of course, that will actually give us a EBIT, which will be the balance 10% of sale. Okay. So our task would be first to get the sales figure. Now for that sale, we'll have to take help of fixed asset turnover. We'll have to take help of fixed asset turnover. So essentially, before going for depreciation, would actually go ahead with calculation of the sale. Sales calculation. So sales calculation is going to be based on the fixed asset turnover on the basis of cost of fixed asset. Fixed asset at cost. So that's going to be linked to the 6 lakh. And finally, we can say that sales figure will be 1.5 times of the 6 lakh. That should be actually 9 lakh. So 6 lakh multiplied by 1.5. So we get a sales figure as 9 lakh. And that's like we can quickly run through the entire thing because sales is 9 lakh. So material cost will be 9 lakh multiplied with 40%, right? So that's this. We can simply say that material cost is 3 lakh 60, labor is 2 lakh 25, manufacturing is 90, office and selling expense is 90, and debris is 45,000. And of course, on the similar lines, we can get the EBIT, earnings before interest and tax. Now, since we are going with the P&L statement, let's complete that fully and then we'll go for a depreciation and all such stuff. So from EBIT, we know we subtract the interest. Now, interest will be, of course, based on what we have as the debenture. And the question is clear about the debenture issue. It stated that the company has issued 50,000 worth of 12% debenture. So 50,000 is what I placed over here. And accordingly, our EBIT calculation will be 50,000 multiplied by 12%. So it works out to be interest on debentures as 6,000. But wait, look into the balance sheet and do we have any other uh, debenture interest? Any other question? In the question, do we have any debenture interest? 12% debentures, and the question company has again issued 12% debentures. Okay, guys. So in case of debentures, what we can say is originally it was 50,000, and of course, additionally, sorry, originally it was 60,000, and additional 50,000 debentures are issued. So plus 50,000. So 1,10,000 is the amount of debentures, and accordingly, what we can say is 1,10,000 into 12% will be the amount of interest. So interest on debentures 13,200. Okay. So we get from this profit before tax. The profit before tax is 90,000 minus 13,200. 76,800 is the profit before tax. And from this we reduce the taxation to be specific provision for tax. The provision for tax and the tax rate, if you observe that given in the question, right, 50% will be tax rate. So this into 50% should be the tax rate. After the provision for tax, we get the profit after tax, which should be 76,800 minus 38,400. 38,400 will be our profit after tax. Then we have the preference dividend to be paid. Now, preference dividend, there's no information about any additional preference dividend being issued. So we'll say preference dividend continues to remain same as given in the question, 1 lakh. We'll have the preference dividend as 1 lakh multiplied by 14%. So preference dividend is 14 lakh, 14,000. We finally get the net profit for equity shareholder. And remember, even the equity shareholders' profit is not directly transferred to reserves because there is some dividend payment that's happening. In the question, it says there is a dividend payment at the rate of 10% is paid in the March. So I need to subtract the dividend over here. Or to be precise, the equity dividend. Equity dividend, which is which is stated as 10%. 10% of 2 lakh because 2 lakh is the equity share capital and there's no issue of additional equity shares as stated in the question. So this is supposed to be remaining 2 lakh itself. Right? So 2 lakh, it continues to be 2 lakh. Finally, we have equity dividend of 20,000 and then the balance transfer to reserve, which is basically 4,400 is what is going to be transferred to reserve. So here we get the P&L account balance as 4,400, right? 4,400. General reserve, there's no additional transfer, so that continues to be remaining same as there in the question, 40,000, correct? Um, Now it comes the depreciation part, right? So the depreciation portion, or rather we can say accumulated depreciation, the accumulated depreciation will be originally the depreciation was 1,60,000. Add to it will be the depreciation of the current year, that's 45,000. That's actually like 1,60,000 plus 40,000. 2,05,000 will be the depreciation value. Right? And so we have a net block as the difference between both, which is 3,95,000 is the amount of non-current asset. Okay. Then we have the remaining figures, stock, debtors, and the cash balance. So we get the stock. For stock, we have been given some sort of information. Stock turnover ratio is 14.4. That's based on average stock. So let's have a working note for it. Working note for stock. Now, of course, for stock, we need to work on the average stock. Now, for stock, of course, material is what going to be used. The stock turnover will be using the stock turnover. Stock turnover is computed as COGS upon, since it's a total stock, we are not talking of raw material. So overall finished goods stock we are talking of. So COGS upon uh, average stock. So first we need to get the COGS, right guys? We need to get the COGS figure because then only we can go ahead with this part. So we need to get the COGS. COGS is simply going to be material plus labor plus any sort of overheads. Material plus labor plus overheads. So we have got from the P&L statement, right? We have got from the P&L statement how much is the material cost plus the labor cost plus the manufacturing cost. We get 6,75,000 as the cost of goods sold. And since stock turnover is given in the question as 14.4 times, that 14.4 times is equal to COGS of 6,75,000 upon average stock. We'll have the average stock figure as 6,75,000 divided by 14.4 as 46,875. Now, of course, this average stock, we know that the average stock of 46,875 is essentially equal to that's opening plus equal to opening stock plus opening stock plus closing stock divided by 2. Opening stock plus closing stock divided by 2, right? So, but we have the opening stock figure essentially, right? We have the opening stock given in the question, which is stock in trade of 60,000. So that essentially means that it's equal to 60,000 plus the closing stock, the whole thing divided by 2. Okay. Now simply solving it arithmetically can get the closing stock figure as equal to 46,875 into 2, subtracting it with 60,000. 33,750 should be the closing stock figure, right? 33,750 will be the closing stock figure. Okay. Then talking about the debtors, again in the question we have debtors given. Debtors is 1/9 of the sale. That's pretty simple to do. Whatever we have got the sales, simply divide it by 9. Simple. Uh, Cash, nothing has been specified, but for current liabilities, originally it was 1 lakh. But talking from the current perspective, what we would be having in the current liability would be first, of course, creditors, right? And then we would have, along with creditors, tax provision. Creditors and tax provision. Now, creditors in the question, they're saying that creditors will be 1/5 of material cost. That's even much better because we can simply link it with the material cost. So material cost divided by 5. That's our creditors is 72,000. Tax provision. Tax provision, of course, we can get it from the P&L because that's provision for tax. And ideally, we know this should tally, but right now we know that it won't because since it's a calculated thing. Okay, so taking it in this way, that's 5,28,750, and on the other side we have 5,64,800. So there is this cash balance which is yet to be entered, and that's going to be the balancing figure there. That's going to be the balancing. So that's like 5,64,800 minus 528,750, and that should be the balancing figure. This should give us the answer as 36,050 as the cash balance. Okay, so that's how we have this solution for us. Now let me see if there are any queries. Okay, queries. Okay, cost is 6 lakh. Where is this question? This question is not there in study material, right? As I have stated in the beginning of the lecture, this is the question which I have uploaded on the portal, on the VOS portal. You were supposed to download it and look at it. Okay, any other queries? Explain 12% debenture. 12% debentures in the opening we had 60,000 12% debentures and additional 50,000 debentures are issued. So that will be 1,10,000. And then we have the depreciation also. So depreciation is like they just stated that that depreciation is 5% of the sales. So that depreciation will be added back to the accumulated depreciation of 100%. What is asking are profitability ratio, efficiency ratio, liquidity ratio, solvency ratios in financial management. Of course, they are there. We have covered it in the last class. Okay. Question itself states 5% depreciation, Prachi. Question itself says that depreciation amount is 5% of sales. We have followed the same. Okay, so with that, we're done with both the questions that we have set for today. Right now, let's just take a break of 10 minutes. And after that, I'll take up the illustration and the practical problems from the study materials which you have identified, which you have pointed out. Okay, fine. Then let's take a break, guys. Okay, welcome back, guys, after the break. Now it's turn for some of the study material questions that we have requested. So I'll take them up. Before that, let me just see if there are any queries. It says Vinay is asking, sir, for fixed asset turnover, we taken gross asset instead of asset less depreciation. Vinay, that's because question itself tells you that you need to calculate the fixed asset turnover is based on the cost of asset and not on the WDV. So therefore, we have considered on those lines. Okay. Then there's the same question. Vinay has asked. Okay. No other such queries. Fine. So let's take up the questions on the study material. I think it was illustration 2 that was requested. So let me just take up the illustration number 2. Illustration number 2. Here we have. Okay. So the illustration 2 we have following is the okay. I don't know, guys. At the start, there was some issue with the Excel, not able to navigate, but right now it's just working. Some technical issues. Let's anyway focus on the question, illustration number 2. Following is the abridged balance sheet of Alpha Limited. Uh, Abridged balance sheet of Alpha Limited we have, and it talks of some information. It says land and building, plant and machinery less depreciation, share capital, profit and loss account, current liability, stock, receivables, bank. With the help of the additional information furnished below, you are required to prepare the trading and profit and loss account and balance sheet as on 31st of March 2021. Share capital is supposed to be 50%. Shareholders' funds is supposed to be other shareholders' funds supposed to be 50%, 5% debentures, and then current liabilities of 25%. Okay, so that's the ratio which we have of the liability side. Debentures were issued on 1st April, interest being paid annually on 31st March. Land and building remain unchanged. Additional plant and machinery has been bought, and a further 5,000 depreciation has been written off. Total fixed assets then constituted 60% of total fixed and current assets. Working capital ratio was 8 is to 5. Quick assets ratio was 1 is to 1. The receivables, which is 4/5 of the quick assets to sales ratio, revealed a credit period of 2 months. There is no cash sales. Return on net worth is given. Gross profit is at the rate of 15%. And then we have the stock turnover, that's 8 times for the year. Now, for this question, primarily, let's prepare first the format. And that format we can think from the point of view projected profit and loss account and the balance sheet. Let's try to prepare that format. Okay, so let's keep the projected P&L and the balance sheet. We need the 4 columns. Okay, and here we go. So this is projected profit and loss statement. Projected profit and loss statement, and besides that, we'll have the projected balance sheet also. Okay. So let me just adjust some of the width so that it looks proper. So even in exam, we should prepare first format so that at least you have a direction to begin with in any form of this type of question, to prepare this format so that you are some sort of not left, direction left. Okay. Now, that doesn't mean that you will get the marks if you just prepare the format, by the way. Okay. Then you will come back and say that, sir, I stated that prepare the format. Format is just for providing us a direction. Okay. Now, projected profit and loss will have the sales, and depending on what we have in the question, uh, the question is telling us only about the gross profit. It's not stating anything about any other purchases or anything as such. We can say this should be simply for COGS. That should give us the gross profit, sales, COGS, the gross profit. Uh, Probably we should take a total of these two, and then this. Then our gross profit should come up over here, right? What all other items do we have in the question? If we look at it, return on net worth is what they've given, 4/5, land and building. The question has debenture. Of course, debenture interest is what we are going to have. And then um, maybe some sort of other expenses. We'll have debenture interest and some sort of other expenses. Maybe just a balancing thing over here, other expenses. And that should give us the net profit figure, right? Taking a summation of these items. Sales, COGS, gross profit, net profit. Then coming to balance sheet, if you look into the question format, in the balance sheet, we have land and building, plant and machinery, stock, receivables, and bank. So of course, these things are by default going to come up in our books. So we would like to have it as over here. Land and building. Then we would have the plant and machinery. Now, plant and machinery, we would be like, it should be at cost and then less depreciation. That should give us the net block over here. And then in the current asset, we can have the stock, receivables, then we have the bank. Actually, it makes sense for us in this case to have it a double column for you know, uh, asset side, because ideally to write the net cost or net figure as such. Then on the liability portion, we have share capital, then we have profit and loss account, and then current liability. Share capital, profit and loss account, the current liability, and there's a debenture issue also. So I need to look into that also. 5% debentures. Okay. So here we have the numbers. Stable stock bank. Okay, fine. Format is ready, guys. Now we have to run through the same thing. Now, first up, the question is silent about share capital. Question is silent about share capital being 1 lakh. The share capital would continue to be 1 lakh. Uh, Now, of course, I'll use this share capital 1 lakh item over here. Now, with that 1 lakh, as per the information in the question, share capital is basically 50%. Share capital is 50%. Profit and loss account stands at 15%. Debenture is 10%. And then current liability is 25%. Okay, share capital of 1 lakh. Now, of course, if that's the 1 lakh figure, can't we simply say that profit and loss account will be, since it's 15%, so we can simply cross multiply it and get the figure, right? You can get it simply uh, the 15% in comparison to this 50%. Uh, we'll verify that, but right now 5% debentures are issued. We'll consider that also, and that's going to be 1 lakh multiplied by 10% divided by 50%. That's 20,000. Current liability will be 1 lakh multiplied by 25% divided by 50%. That's going to be 50,000. 1 lakh, 20,000 and 50,000. 1 lakh, 20,000, 50,000 current liability. Uh, Profit and loss account also, since they're stating it to be in the similar line, so 1 lakh multiplied by 15% divided by 50%. So technically, we are getting it in the form of a cross multiplication number. That is what we have over here. Now, then coming to the further part, that's the first thing that we have done. Additional information, and based on that, we have this share capital, other shareholders funds, 5% debentures, current liabilities. That's done. Debentures were issued. So of course, I need to include the interest in my P&L statement also. So in my P&L statement, debenture interest, I would like to have it as 5% of 20,000, right? So 20,000, 5%, that needs to be considered. 20,000 into 5%. 20,000 into 5%. So 1,000 will be the debenture. Okay. Then look at this. Land and building remain unchanged. Land and building remained unchanged. So land and building remain unchanged. Additional plant and machinery was bought for 5,000. Depreciation was written off. Okay. 5,000 depreciation was written off. Land and building is remaining unchanged. So whatever it was earlier land and building was 80,000, right? Let's write it as 80,000. Plant and machinery, it's 50,000, and it says that additionally we bought uh, some additional plant and machinery. Additional plant and machinery was bought, and 5,000 was written off. Further 5,000 was written off. So total depreciation that has been charged will be like the original 15,000 plus additional 5,000 is what is depreciation written off. And now the question says that total fixed assets then considered 60% of total fixed and current assets. It means the total of fixed assets, land and building and plant and machinery, is actually 60% of total assets. Okay, so if we consider a working note, probably over here, total fixed asset divided by total assets, total fixed assets divided by total assets is going to be equal to total fixed assets upon total assets is going to be equal to 0.6 because that's 60%, right? Now we don't know what the total assets as such. Uh, do we know? Yes, of course, sir. We don't know the total assets over here, but surely we know what is the total of our liabilities. And obviously, ideally, total of all our liabilities should be equal to total of the assets, right? So total of assets, we can say uh, total fixed assets upon total of assets is basically going to be equal to that's basically going to be equal to this 2 lakh figure. That's equal to 0.6. And then we have total fixed assets as 2 lakh multiplied by 0.6 is 1,20,000 is the total fixed assets that we have. Right. So total fixed assets is 1,20,000. From that, we can actually reduce the land and building. And the land and building is 80,000. We have plant and machinery value. Plant and machinery value will be 1,20,000 minus 80, it is 40,000. So essentially, our plant and machinery figure is this 40,000. So what should be the cost, sir? If after depreciation this comes out to be 40, of course the cost will be the reverse calculation. That should be ideally 60,000. Correct? Okay, perfect. Then working capital ratio was 8 is to 5. Now, working capital ratio 8 is to 5 means we are actually talking of the current ratio, right? Working capital ratio means nothing special. It's just the current ratio. Current ratio is 8 is to 5. So that's 8 is to 5. We have 8 is to 5. Current ratio. So current ratio is current asset upon current liability is 8 upon 5. Now out of this, we have a current liability of 5 lakh. Current asset, current liability of sorry, not 5 lakh, 50,000. 8 and 5. Okay. So we would get the current asset simply as 80,000. Current asset is 80,000. So that's actually a total of stock receivables and bank, right? Stock receivables and bank. So in totality, it should be this figure 80,000. Okay. Then stock receivables and bank individual items, if we see, they're saying quick ratio was 1 is to 1. Okay. So we have this quick ratio as 1 is to 1. Now, how do we get that quick ratio? We have stated it in our previous calculation. Quick ratio is basically all your current asset minus stock and prepaid expenses in the numerator. But whatever we have is basically receivable plus the bank balance. upon the current liability. So we have the quick ratio number. Uh, Quick ratio number is 1:1. So 1 is essentially equal to 1 equal to receivables plus bank upon current liability figure. That's already what we have stated over here, 50,000. So receivable plus bank will be 50,000. Receivables plus bank will be 50,000. So these two are equal to 50,000. But sir, how much is receivable and how much is bank? That is still not known to us. So we'll have to look for the next ratio, which is about receivables. So they say receivables is 4/5 of the quick assets. So out of quick assets, receivables is 4/5, and it has some credit ratio, right? So from this, we can actually get receivables is equal to 4/5, 4/5 of quick assets. Receivables will be 50,000 multiplied by 4 divided by 5. 40,000. Receivables, 40,000. Right? So we got the receivables as 40,000, and then undoubtedly the bank balance will be simply 50,000 as reduced by this receivables. The balance, we have bank of 10,000. And without any further thing, we can say that since receivables and bank are 50 and total current asset is 80, of course the stock amount is 30,000. And this should basically tally. The total 8 plus 8 plus 4, that's balance sheet getting tallied. Remember, we still have this profit and loss statement to be filled up. Now, profit and loss statement, we have to begin with sales. And for that, the question is stating receivables 4/5 of the quick assets to ratio revealed a credit period of 2 months. So debtors collection period is 2 months. So we have the debtors collection period as 2 months. Debtors collection period is 2 months. Now, since the debtors collection period is 2 months, and we have the debtors number also, right? So debtors collection period, that's basically derived at sales multiplied by, or that's simply sales divided by debtors multiplied by 12. That's equal to that's equal to 2. So sales divided by debtors into 12 is equal to 2. Or 1 second, the reverse formula, because when you say 2 months, it means how much debtors is in comparison to sales. So debtors divided by sales into 12. Debtors divided by sales into 12. So we can get the debtors. We can simply say that our sale is essentially, sales will be the amount of debtors. Right? If you just rearrange it, take sales on the other side, 2 comes on the other side. We need the sales. That will be debtors multiplied with 12 divided by 2. We get the sales figure as debtors into 12 by 2. So we have the debtors of 40,000, right, into 12 by 2. The sales amounts to 2,40,000. Sales amount to 2,40,000. 2,40,000. What about COGS? Gross profit was at the rate of 15% of selling price. Gross profit is at the rate of 15% of selling price. So of course, this is going to be the sales multiplied by 15%. 36,000 is the gross profit. But obviously, the COGS is going to be the sales multiplied by, since 15% was your GP, 85% will be the COGS. 85% will be COGS. This gross profit is what we carry it forward. 36,000. Other expenses. Gross profit 36,000. Debenture interest is 1,000. Other expenses. Now for that I need to look at the net profit. Return on net worth was given as 10%. So since we have return on net worth as net profit upon share capital plus reserves, and this figure is given as return on net worth is 10%. We can say net profit, we don't know. Of course, our net profit is going to be equal to 10% of share capital plus reserve. Net profit will be equal to 10% of 1,30,000. We can say that our net profit is 1,30,000. So that's essentially 13,000. The net profit is 13,000. And sir, there is still a balancing other expenses. That's going to be pretty clear that it's 22,000, and this other expense is a balancing figure. There's a balancing figure, right? And that brings to us the solution for this illustration 2, as you have requested. Let me see if there are any queries. Queries, difference between P&L. Managed P&L is the actual P&L. Projected is the future P&L. How receivable and bank 50,000. Current liability is given as 50. So receivable and bank, on solving it, you should get it as 50. Okay. Next is 4/5 of 30,000 is quick assets. Why am I with 80? Where am I minusing with 80? If I subtract from 80,000, I'll get the stock figure. Okay, why are we not showing depreciation and separately in profit and loss? Uh, yes, you can show it. You can show the depreciation. I'm just taking it as other expenses. You can have a column as depreciation and then the other balancing figure. You can have it. You can do it, guys. No issues then. Okay, which was the other question that you guys were asking for? One was this illustration number two. Which was the other question? Which was the other question that you were saying? Practical problem. Was it one or two? What was it? Just wait for maybe a couple of minutes to get your response, or else I'll go for the DuPont chart. Practical question three. Okay, practical question three. Okay, this one. Let me just do this practical question three. Practical question three. Okay. Illustration four. Vinay is asking the first line of illustration four. What's there in illustration four? First line of illustration four. Prepare the from the following ratios. You have to prepare the trading account and P&L. It's just the same question. Nothing difficult in it. Let me just do the practical question three now, because that's been a request. So let's just solve it. Following is the accounting information and financial ratios of PQR Limited that relates to the year ended 31st March 2021. Accounting information, gross profit is 15% of the sales. The gross profit is 15% of the sales. Net profit is 8% of sales. Raw material consumed is 20% of works cost. Direct wages is 10% of works cost. Stock of raw material is 3 months usage. Stock of finished goods is 6% of works cost, and debtor collection period is 60 days. All sales are on credit. Okay, fixed asset to sales ratio is given. Fixed asset to current ratio. In fact, what is this? This is what we have done right now in the first place, right? The first question that we did was the same. Yeah, so that's fine. This is the same thing. I'm not doing this practical question three. Any other thing? The other request is illustration five. Okay, illustration five. Let's try to do the illustration number five. Okay. So illustration five, ABC company sells plumbing fixtures on terms of 2 by 10 net 30. Its financial statements over the last 3 years are as follows: 2018-19, 1920, and 2021. So this means plumbing fixtures on terms of 2 by 10 net 30. It simply means that these are the credit terms it offers to its debtors. So debtors are actually told that if you pay within 10 days, debtors are told if you pay within 10 days, you will get a discount of 2%. Okay, if If the debtors pay by the 10th day of sale, they'll get a discount of 2%. And if they don't want discount, they need to pay by 30. They need to pay by the 30th day. Okay. And then we have some of the numbers given: cash, accounts receivable, inventory, net fixed asset, accounts payable, any sort of accruals, short-term bank loan, long-term debt, common stock, and then retained earnings. So we have sales, COGS, and the net profit figure. Consider opening balance of the accounts receivable and inventory as 2 lakh and 4 lakh respectively. Analyze the company's financial condition over the performance of the last 3 years, and are there any problems? So we have computed some ratios over here. Okay. So looking at those ratios, we have to come up with some sort of conclusions. And I think the conclusion is also stated up over here. See. So I think the numbers are quite self-explanatory. I need not look at these ratios as such. Correct? Sharon is asking COGS of previous illustration. COGS of previous illustration. This one. Sharon, it is stated na gross profit is 15%. So COGS will be balanced 85%. Okay. So over here in this current illustration, we have some ratios which are calculated. So ratios are calculated, of course, some of the ratios that they calculated is current ratio. Then they have used you can say asset test ratio, receivable turnover. So they have calculated a lot of ratios, and based on those ratios, we have to do some sort of analysis. So current ratio calculation will be, of course, current assets upon current liabilities, which is this 6,30,000 divided by a current liability of 5,30,000. That's stated over here. Then asset test ratio is quick assets upon current liabilities. So quick assets will be only accounts receivable and cash. So that's 2,30,000 upon 5,30,000. 2,30,000 upon 5,30,000. Receivables turnover ratio, or I can say debtors turnover ratio. That's like sales upon the accounts receivable. So sales of 40 lakhs that we have, and we take the 40 lakh, and then we take the 40 lakh divided by the average accounts receivable. So we take average accounts receivable, or opening balance of accounts receivable was 2 lakh. So 2 lakh, and 1819 closing is also 2 lakh. So average will be also 2 lakh. So in this way, these ratios are calculated. You can just go through the calculation. Meanwhile, I'll just take up some queries. If there are any queries in this calculation, do let me know. One is asking, explain the cost of goods sold, clear debtors collection period. For illustration line, can you explain total debt to total net worth for 1 year? Okay. Total debt to total net worth. Total debt will be basically short-term debt plus long-term debt. Short-term debt is 1 lakh, long-term debt is 3 lakh. So 1 lakh plus 3 lakh, that amounts to total 4 lakh. So short-term debt to long-term debt, that's ideally total debt to long-term to net worth. Short-term plus long-term debt, we have this as 3 lakh plus 1 lakh, perfectly. Short-term debt. So that's when you say total debt, it should be total liabilities basically. Okay, so that's 5 lakh 30 plus 3 lakh. 5 lakh 30 plus 3 lakh, that's total to 8 lakh 30. Okay, 8 lakh 30 divided by total debt to net worth. So net worth is basically this common stock and retain, which is 6 lakh. 1 plus 5, 6 lakh in the denominator, and then the total of liabilities in the numerator. So short-term borrowings and long-term borrowings, including the creditors, is what we have considered. That's actually not total debt. That's total liabilities. Okay. Nanesh is asking, how do you know when the debt is long-term debt or short-term debt? Okay. Vinay is asking, shall we take the total debt as total liability, sir? Uh, Whenever we say total debt, you should consider the total liabilities, surely. And because that's a borrowed capital which you are using. But if the question specifically says long-term debt, you should take the long-term debt, or if it says only short-term debt, you should take only the short-term debt, not to intermingle both of them. Okay. Fine. Now, have you calculated the numbers? Any query in these ratio numbers, guys? Any calculation which you are not getting of these ratios, which we need to explain it to you, or else we can go with the analysis part of this. Have we calculated the numbers at least for 1 year so that you can just extend it to the other years also? Any ratio that you need me to explain? Just wait for a minute for that answer to come up. Okay, why inventory turnover NA in 2016? Inventory turnover. There's no 2016 over here. In the first year, there is no closing balance of trade receivables. Why are we dividing it by 2? In the first year, we have this opening balance of 2 lakh, right? And then this is a closing balance of 2 lakh. So basically, it remaining the same. So 2 lakh is the same answer as the opening and closing. In case there are sales returns, should we take net sales? Yes, Vinay, you should take always the net sale. Rachi is asking, please clear debtors collection period. Rachi, we have done that in the last class. I'm not sure whether you were there or not. Let me just go through the analysis part. If time permits, I will surely go through the debtors collection period also. Now, if you look at the current ratio, that's 1.19, 1.25, and then 1.20. Is the current ratio improving? Is the current ratio improving, or is it stagnant, or what's the status? Right? If you look at the current ratio, what could be your answer? We know that the current ratio, ideal ratio is 2 is to 1, and ideal quick ratio is 1 is to 1. So if we compare the current ratio and the quick ratio of this company, we'll find that it's not that pretty good enough. So it doesn't have enough resources basically to meet the current obligation, right? Right? You can see that it's below 2, and even the acid test ratio, the quick ratio, is below 1. So that's not a good sign. Receivables turnover, sales upon average receivables, and that's where we get these numbers as 20, 18.7, and 13.82. So what do you mean by this receivables turnover now? Debtors turnover or receivables turnover? It means out of 40 lakh total sales, we had 2 lakh in our debtors. We had 2 lakh in our debtors. So basically, I was selling product to the debtors 20 times in a year. In a year, I was actually selling it 20 times in a year. Then in 1920, it reduced to 18.7, and then in 2021, it reduced further to 13.82. So it means I'm not able to sell the goods as quickly as I was doing it earlier. So maybe the collection pace has actually slowed down. The receivables collection pace has actually slowed down, and that's a problem area, right? Then, if you look at the average collection period, also that is in line with what our analysis for the receivables turnover is. The average collection is 18.25, 19.52, and 26.41. So more days are being required to collect the money from the debtors. That's a bad sign, right? So they are suffering from liquidity. Similarly, if you look at the inventory turnover ratio is also, it has also reduced. What does that inventory turnover ratio reduction mean? Sir, earlier I was selling one lot of inventory 8 times in a year, and now I am able to sell only 6.11 times. It means I'm not able to sell my inventory at a very faster pace. It means I'm holding a lot of inventory in my books, right? So you can see the inventory values also 4 lakh, 4 lakh 40, and then 5 lakh 40, the average inventory. That clearly indicates that there is a slowly and steady piling up of inventory that's happening, which is not, the company is not able to sell those inventory. Then, if you look at the long-term debt to net worth, that has also increased. It means you're taking more and more debt, and that's again a risky situation, right? That's a situation where the scenario is quite grim, that more and more loan is being taken, whereas the profit margins have actually shrunk. The net profit margin has shrunk, and even the gross profit margin has shrunk. Right? So they have reduced substantially, and of course, that means even the company is suffering from the profitability angle also. Company is not doing much good. Uh, Then, if you look at the total asset turnover, we are not able to utilize the assets. Assets are also getting not much utilized. And then return on assets, that's net profit to total sales. Net profit to total assets. That has also reduced drastically. And it means overall company is not doing good in profitability, neither in terms of turnover area. So that's a little bit of problem area which the company is suffering from both the sides. It's suffering from turnover, that it's not able to sell the goods as fast as it was earlier. Neither it is able to generate profits. Okay. So that's where we say the company is really not doing good, right? So overall, company is suffering from profitability, from the turnover issues, and that's ultimately leading to return aspect also. So from the return point of view also, company is not really doing good, and it need to be really focusing on either on the turnover part or on the profitability segment. Otherwise, the future seems to be dark for this company. Okay. So any queries if we have? These accounts payable and accrual are short-term debts. They aren't short-term debts, but we do consider it in total capital or total liabilities. Sharon has explained total capitalization. Total capitalization is a total of long-term debt and the equity shareholders fund. Shareholders equity plus long-term debt is what we have total capitalization. Rajiv, I have answered a question earlier. This was a question from some of the other students which stated which ratios are we supposed to be knowing. I would say that whatever ratios you can calculate from these numbers, go ahead with all of them and try to analyze. Obviously, by just mere look at it, you can calculate current ratio, quick ratio, then you have fixed turnover, accounts, debtors collection period, creditors payment period, inventory holding period, debt equity ratio, debt ratio, equity ratio, capital gearing. You can calculate a lot of ratios. So whatever ratios you can, you should calculate and give a holistic analysis for the typical question. Okay. Now, as I said, that company is not doing good in profitability and neither in the turnover area. So there's a aspect above that's called as a DuPont analysis. Just try to go to it. So there's this DuPont analysis which we are yet to cover. This I won't be able to cover today, but I'll be surely covering this in the revision class that we have of ratio as well as the capital structure. So both the things will be covering up in that session. DuPont analysis and few ratios that we have in the revision class. Alok is asking for analysis. We should have knowledge of all ratios, just like which ratio should be used, which should be high, which should be low, right? Yeah, correct, Alok. You should be knowing that which ratio is favorable for you and which isn't. That idea you should be having clearly. Okay, so DuPont part I haven't yet covered because that is yet to be seen or yet to be discussed in detail, and we don't have time as such now to discuss this DuPont chart because I'll require around 15-20 minutes. So I'll take up a course, I'll take up a part in the revision class in which the revision session, probably in the initial 15-20 minutes, we'll discuss the DuPont and then the few ratios that we are yet to cover. Okay, any other queries, guys? I'm just waiting for your queries. Okay, Vinay is asking sales of in case of sales return, should we take net sales? Yes, you have to take the net sales, Vinay. Any sort of queries, guys? Any further queries that I need to answer? Or else we'll just call it a day. Practical question 5, we'll do that in the revision class. Take a note of whatever questions you have. Go through the questions, and if it's required, we'll discuss that in our revision class of ratio and capital structure that we have probably a couple of lectures later. All good? Fine. Nanesh, you can ask the questions in the revision class that we'll have. We have a revision class scheduled probably on 8th, I suppose. 8th of February, we have the revision class of two chapters. In that class, you can definitely ask the query for this chapter. Okay, fine. Yes. So with that, I think we should just stop here for the day.